Let's go on to the story of value investing. And of course, the icon of value investing is nonetheless Warren Buffett. And Warren Buffett said that if you want to learn about value investing, there are two books that you should read. One of them is The Intelligent Investor, and the other is The Common Stocks and Uncommon Profits. The Intelligent Investor is, of course, written by the renowned father of value investing, Benjamin Graham. Warren Buffett had a lot of admiration for this man, such that he actually enrolled into Columbia School of Business just to learn from Benjamin Graham himself. And thereafter, he worked for Graham in his analyst firm for a few years before starting out on his own. And alongside Warren Buffett, there are many successful Graham disciples, such as Walter Schloss. But few people know about him, even though he has very remarkable investment returns. Because in this society, we only remember the number one guy, and the number one guy in value investing is, of course, Warren Buffett, who averages about 19% per year for 50 years. While Walter Schloss had managed a 15.3% per year for 45 years, which is a very remarkable record. For the Common Stocks and Uncommon Profits, the author is Philip Fisher. And Philip Fisher also had a lot of influence on Warren Buffett's investment philosophy, but it was only later stage of his career. And the key figure was actually Charlie Munger, who was able to influence Warren Buffett to switch his investment philosophy towards something more like Philip Fisher. The Warren Buffett today, in my opinion, is a lot more Fisher than Graham. And asking you to read two books with very different investment approach would usually confuse the reader. So, to help you understand the differences, we will separate the value investing into two schools of thought. And the first one is being Benjamin Graham. His philosophy, if simply put, is buying stocks below its current value. So if let's say a stock is worth $1 today and the stock price is 50 cents, which means you are able to get a discount, or in Benjamin Graham terms, margin of safety of 50%. Walter Schloss is someone who has always been following Benjamin Graham method for 45 years, and he was able to achieve 15.3%. So let's move on to Philip Fisher. And his investment philosophy is about valuing a stock based on its future potential, and the current value is not as important to Fisher as compared to Graham. So for example, if let's say the value of a stock is 50 cents and the price is at $1, so to Graham this is grossly overvalued. But if Fisher is able to ascertain that in the future this stock is going to worth $2 in the future, it is a very good buy based on the growth prospect and the increase in earnings that will result in higher share prices in the future. If you remember the two examples that we went through previously, the Ashton kind of stocks versus the Ernest kind of stocks, we would say that the Graham approach is more similar to the Ashton kind of stocks, where they are asset backed. You're able to buy these assets at a discount, whereas for the Philip Fisher kind of stocks are the Ernest stocks, which the value of these stocks highly dependent on the future earnings that the company is going to earn. And I always believe that the retail investor is better off investing based on the Benjamin Graham philosophy than the Philip Fisher, even though you know that the financial industry has always been harping on earnings and earnings and earnings, but actually most people, including the experts, are very bad at predicting future earnings. So for retail investors with limited time and resources, it is much better and easier to invest with the Benjamin Graham approach. And taking Walter Schloss' track record of 15.3% is really very good enough for retail investors to compound your wealth.